So guys, I wanted to talk about income taxes in terms of investing on the stock market. I've been getting a lot of requests to make a video about tax implications on the stock market. So in general, being a resident of Canada, any income you make, whether it's inside Canada or outside Canada, is taxable. And of course, there are different types of income. You've got employment income, you've got self-employment income, you've got rental income, you've got investment income, you've got dividend income, you've got capital gains, and they're each taxed in a different way. They each have their own rules, and they're each taxed at different rates. When you open an investment account, for example, let's say you just open a savings account, Tangerine, for example, and you get interest on your savings account. So if it's in a regular savings account, not a registered savings account, you're going to notice that the interest that you're making on your money, that's taxable at the end of the year, and it's taxable at 100%. So let's say you have $5,000 in a savings account and you made $200 at the end of the year of interest on your savings account, that is taxed at 100%. So that $200 is added to your income. So when you open an account, an investment account, you'll notice you have different types of accounts that you can open. You can open a regular investment account. You can open a registered account like a TFSA, a tax-free savings account, or you can open an RRS, registered retirement savings plan. You can open an RESP, registered education savings plan. You can open a margin account. So there's basically two categories. There's a regular account and there's a registered account. So the regular account, you're going to be taxed on it. The registered account has it, depending on which type of registered account you open, has its own advantages, of course. TFSA versus the RSP versus the RESP, they have different rules, different rates. A regular investment account, so a non-registered account, you're going to be taxed depending on the activity you do, depending on the type of investment. For example, if we're talking stock market, so if you buy a stock, let's say at $10 and you sell it at $12 6 months later, so you made a profit of $2 per share. So let's say that represents $1,000 profit. So because it's considered a long-term investment, it's considered as a capital gain. It's property that you're buying, property that you bought at $10 and you sold at $12. So it's considered a capital gain, and capital gains have their own tax rates. So in that case, you're going to be taxed at 50% of your profit. So if you made $1,000 profit, you're not going to get $1,000 added to your income. You're going to get $500 added to your income, and then you're going to get taxed on that $500 based on the bracket that you're in with all your, because of all your income, employment or rental income, anything else you might have. Dividends have their own tax rate also. So in a non-registered account, buying and selling stocks, the capital gain that's created is taxed at 50%, and dividends is taxed at a different rate. It's a little bit more complicated, but it's taxed differently than regular income. So it's not considered as 100%, but it's not 50% either. If you day trade though on the stock market, it's considered business income. So if you're not just investing, you're buying and selling on a daily basis or even short-term period, that'll be considered a business income, and the business income will be taxed at 100%. So it's no longer 50% like capital gain, it'll be 100%. So if you buy a stock at 10, sell it at 12, you've made, and let's say the profit you made was $1,000, that $1,000 will be added to your income and will be taxed based on the rate that your total income is in. So buying and selling on the stock market, if it's for investment purposes, it's considered capital gains and it's taxed at 50%. So only 50% of that profit will be added to your income and then will be part of the taxable income. Dividends has a different calculations, but it's going to be less than 100% of it. But if you're day trading, it's considered business income. 100% of it goes into your taxable income. Now that's for unregistered account, a non-registered account. But if you take the registered account route, which you definitely should, first of all, let's talk about the TFSA, the tax-free savings account. So anything you contribute to that account, any gains you make from that account is tax-free. So you buy a stock at $10, you sell it at $12, you make, let's say, $1,000 profit. Whether you keep it in the account, whether you withdraw it, it's tax-free. It does not go towards your income. Let's say you started off with $5,000 and you manage to turn it to $20,000 by buying and selling over the years, and you decide to withdraw the full $20,000. That $20,000 is completely tax-free. It does not get added to your income. So that's the real beauty of the tax-free savings account. But of course, it's limited. You can't contribute as much as you want. There's a maximum that you can contribute per year. It started in 2009, and I think it's about $5,500 per year. One year it went up to $10,000, but then they brought it back down to $5,500. So, and if you didn't contribute the past years, it's accumulated. So you can contribute the full amount present year. So I think right now it's up to 57,000. Let's say someone has 100,000, well, they can't put it all in a TFSA. They'll have to put only 57,000. The rest, well, either they're going to put it in a different registered account, or they're going to have to put it in a regular investment account where they're going to get taxed, of course. So TFSA is completely tax-free in terms of the profits you make, even the dividends that you make. Although I heard that if you day trade in a TFSA, that is not completely tax-free, but I can't confirm that. I heard it from other people. I wasn't able to confirm it from the government. Check the website and there's no information on it. So if you day trade in a TFSA, that might be taxable. Not sure, but if you trade on the stock market as a normal investment, any dividends you collect from a TFSA, that's completely tax-free, unless the dividends come from a U.S. stock. So if it comes from an American stock, there's going to be a 15% withholding tax. So let's say you buy a U.S. stock that pays 10% dividends, like actually New York Mortgage Trust, one of the stocks I own, pays 13% dividends per year. So because it's a U.S. stock and I'm a Canadian resident, there's a withholding tax of 15% from on the U.S. side. So I don't get the full 13%. I get 85% of the 13%. So I get about 11% about dividends per year from that stock because it's held in a TFSA. So it's still not bad, not a big tax consequence. Now the registered retirement savings plan, what's beautiful about that is when you contribute to it, you get a tax credit immediately. So let's say you contribute $10,000 to your RSP. That $10,000 is a deduction against your income, your employment income, all your other incomes. That $10,000 that you contributed to your RSP becomes a deduction. So let's say you're making $100K per year and you're being taxed on $100K. Well, if you contributed $10K in your RSP, well then that's a deduction against your $100K. So instead of being taxed on $100K, you'll be taxed on $90K. So you save the taxes on $10K. So depending on the bracket you're in, you could be saving easily $5,000. So that's the advantage of the RSP, is that you get an immediate tax credit for contributing to your RSP. And what you do with that credit now, the smart thing to do is to take that credit and reinvest it, of course, so that your investment portfolio grows fast. Basically, you're getting an extra 50% every time you invest your RSP, and that's beautiful. And your investment, you can invest it on the stock market, and you could grow it by buying and selling stocks. So any gains you make in the RSP, as long as it stays in the RSP, is tax-free. But once you withdraw from your RSP, though, it gets added to your income. So let's say you've contributed over the years. Let's say you have 100,000 in your RSP, you've collected tax credits, and you decide you want to withdraw $10,000 from your RSP. Well, then that 10,000 is going to get added to your income of that year. So the advantage of the RSP is that if you can withdraw from your RSP in a year that you have no income, then you're going to be taxed at a much lower bracket. Might not even be taxed at all, depending on how much you withdraw. So that's the advantage, is that when you contribute, you get a tax credit, and hopefully when you withdraw in the future, you withdraw in a year where you're in a low tax bracket, so you pay less taxes. Now, not everyone expects in the future to be in a low income. Some people plan to always have a high income in the future, or their income grows consistently over the years, and they expect to have a higher income in the future. So in that case, RSP might not be that great. Although even if you end up paying the same amount of taxes you got as a credit in the present, money now, $2,000 right now is not the same as $2,000 in the future. So you're better off taking money now and just paying $2,000 in the future. Plus tax rates change and the exemptions change also. So in 30 years, you're going to be paying less taxes for sure on the same amount of money. So RSP, like the TFSA, also has its limits. You can't contribute as much as you want. It's 18% of your previous year's earned income. It also gets accumulated. So if you don't contribute a certain year, it gets added to the next year. So depending on your employment, on your earned income, you could have a big contribution. And the RSP, like the TFSA, any gains you make are tax-free. It only gets taxed when you withdraw from the RSP. So let's say someone has 100,000. In my opinion, I would say contribute to your RSP first, fill it out completely until you've maxed out the contribution room. Once, if you have leftover, then you fill out your TFSA. Once both of them are filled out, then you have no choice but to go to a regular investment account. Or what you could do is you could open a holding company corporation that sole purpose is just to invest, and you're going to be taxed differently. So that entity, that corporation, has different tax rates, much lower than an individual. But the money has to stay in the corporation. If you want to spend the money, you have to pay yourself. And as soon as you pay yourself, well then you're going to get taxed as an individual on the money that's coming to you. So basically it's the same thing, it's just tax deferral. So it depends on your lifestyle too. If you're not going to spend anything, you just want to see something grow, then once you finish your RSP, once you finish your TFSA, you should definitely get a holding company and invest in that, because you're going to pay much less taxes. But it's expensive to get a corporations, and just the income tax return on a corporation is more expensive also. But depending on the amount of money you have, it might be worth it, of course. So for the average investor, I would say first RSP and then TFSA, and these are the greatest some of the greatest tools that the government created to help us save in taxes. So what really bothers me is some of my tax clients have TFSAs. When I see them opening a savings account in a TFSA, it really bothers me, because the whole point of a TFSA is your gains are tax-free. So you want to maximize the investment that gives you the highest gains, so that they're tax-free. A savings account will give you between 1 and 2% per year. You don't care if 1 or 2% of your investment is tax-free. You care if 10 or 20 or 30% of your investment returns are tax-free. So a TFSA should be used in the type of investment that generates the most return, that the returns will be tax-free. A savings account does not generate that much, so it's a waste of a tool to use a TFSA in a savings account. I think I covered everything I wanted to cover. If there's anything missing, leave them in the comments below. I'll gladly make another video. If you have any questions, also leave them in the comments below, or message me directly on my website. Also, don't forget, if you're going to open an account with Questrade, use my referral code in the description below the video, so you can get between $25 and $250 depending on your initial deposit. Thanks for watching.